Hi, hello, welcome to our channel. In this video we are going to discuss about standard costing. So here standard costing, we have standard costing was bifurcated into behavior issues and contemporary business units. Here we will discuss about analysis of advanced variances. What is meant by variance? Variance means, for example, if you take your actual, you are maintaining one budget, if you have one budget and if you have an actual, in your budget your profit will be 10 rupees and for actual it was 9 rupees. So there is a difference. For this difference we will say that it is a variance in a professional term. So it is a variance. So for this variance we will analyze the variances. Why the variance is came, why the difference is came. For this, is it related to price change, or is it related to material change, or is it related to any other activity was done? This is the variances. So these are the advanced variances which is provided in year. So planning and operational variances, variance analysis, activity based learning curve impact. What is the learning curve impact? Learning curve means what? That is, for the first time you will take more time, and the second time you will take the less time, and third time you will take less more time. That is the learning curve impact on variances. At the least time you will take some time only. Next, variance analysis and throughout accounting, and variance analysis in advanced manufacturing environment, various analysis in service industry, variance analysis in public services. This is the case. Next, planning and operational variances. This is planning and operational variances. Firstly, we have planning and operational. These all are advanced variances. Basic variances are why the material variance or price variance or labor variance. We will see that normal variances. For firstly, we have price. This is advanced variances. That is planning and operational variances. Here, it is a simple comparison of revised standard to the original standard. So it is a simple measure, simple comparison, compares with revised standard to original standard. So for revised we will see the original. For these two compare, it is known as planning and operational variance. Where operational variance is, this is planning variance. So this is planning variance, where revised standard to the original standard, we will see the comparison. Next, where operational variance means simply actual results against the revised amounts. We will see the operational variance. This is operational variances. And where the operating variances would be calculated after planning. So first we will see the planning variance. This is here, see, revised standard to original standard, and operational variance is actual results against revised, and operational variance is calculated after the planning variance. So first we will calculate the planning variance. Planning variance means what? Simply revised standard to original standard we will compare, and operating variance means simply actual results. What is the actual result? What is the revised amount? And operating variances would be calculated after planning variances have been established, and that's a realistic way of assessing performance. Next, controllable. Here controllable variances are those variances which arise due to inefficiency of a cost center. Where if you have a cost center, and for that cost center if you are a inefficiency, then here controllable variances. And where the uncontrollable variances means due to factors beyond the control of management, that is uncontrollable variances. Here we will see in example, in specification they provided that actual result. This is a actual result, and ex-ante standard. We will compare this. This is total variance. It will split into two categories. So it will split into two categories. It is for actual results and ex-ante results. Comparing it is operational results, and we will see with post standard and anti standard. It is planning variance. So simply we are seeing here original standard and revised standard. Here we will compare the original standard and revised standard. That is planning variance. Here we will see the actual results, revised amounts, that is operating variance. Next, for example, we will see one example. They provided that example was factory X is there, factory X is there, it is providing original standard, revised standard, actuals, and original standard is named ex ante, revised standards is named ex post, and actual will be 4500 units. What they are standard, but is like a budget. It is providing 4500 units into 2, 4500 into 2, it will be 9000 kgs. So 9000 kgs into 12.5, that is they are estimating at the rate of 12.5 for the 9000 kgs, that is 1,12,500. Next, revised standard, what it was revised, they revised that cost may increase, that amount will be go 2.25. firstly they plan for 2 rupees, and they are planning for it may increase due to some factor they are considering, the cost may increase 2.25, and quantity will be same, next 2.25 kgs into 11.5. so here there is a change in price and their quantity, total units was same. Next, this is revised standard, and they provided actual. What the actual was happen is purchased 8750 into 13 rupees. So he has purchased, it is 12.5 and revised with 11.5, but he has purchased 13 rupees. Next, 13 rupees is 1,13,750. What we require for, if you going for traditional variance, if you are going for traditional variance, if you see the here, firstly for quantity, for price, if you are multiplying with price, always take the standard price. Next, if you are multiplying with quantity, always take the actual quantity. This is the thumb rule. Next, why this is, we will see here, using variance, usage variance, price variance, total variance. We have 3 variances. What is the usage variance? Means based on quantity. So for quantity we require to quantity difference. For quantity difference into price, what price we will take? Price means always standard price. Standard price will be 12.5, and we are seeing the quantity difference. So what is the quantity difference? 4500 into 2, that is we are estimated this, and after that it was actually taken 8750 into standard price. Next, here we will see the price variance. For price variance, what is the price for standard price and what is the actual price into quantity? Which quantity we will take? Actual quantity. So quantity means always actual quantity, we will take the actual quantity. Okay. Next, now total variance means what? It is favorable and it is adverse. Favorable means positive sign, adverse means negative sign. So after it will be overall be adverse sign. It is traditional variance. Next, operational variance means what actually done, what actually happened, what actually happens. See, for thumb rule, selling price will be standard we will take, and quantity means actual we will take. This is the thumb. Next, we will see this usage variance. First, usage variance means now we will not consider this one. For this operational variance means actually performance day, what we are revised, this was revised. So 4500 into 2.25, that is 10,125 kgs and 8000 kgs. So we are usage means quantity difference into price. Which price we will take? Standard price, that is price means standard price. So 11.5, that is we will get the favorable. Next, price variance means price difference into what we will take? Quantity. Which quantity we will take? Quantity means always actual. So 8750 will be taking. We will get the total variance. Next, now planning variance. Next, planning variance. Planning variance means what? These two are both are plannings only. These two are both plannings only. So traditional variance means firstly what we taken, this is traditional, this is we will compare. And operational, during the time what the we have information, we revise our standard. So operational variance means revised standard plus actual standards. And planning variance means total two plannings. These two plannings, what is the original standard and what is the revised standard. For this we will calculate same. For that we will take this. Here what is the actual we will take? What is the actual we will take? Actual will be, this was the actual, this was the doing the operation, so it will treat as a actual. It is the standard. For planning variance, so first usage variance means quantity difference. 4500 into 2 9000 and 4500 into 2.25, which price we will take? Price means always standard price 12.5. Next, price variance means what? We will take the price difference. Price difference means 12.5 minus 11.5 into quantity means which quantity? We will always take the quantity, but we are not seeing the quantity here actually, so we are seeing both plannings. So for that plannings, which is the revised planning, latest quantity is there, this is the listed quantity. So 10,125 we will take up. So now we will get the price variance. Total variance will be one favorable, one adverse. This is the case of that. Next, here we will see direct material usage variance. Firstly we have in this chapter more formulas. How many formulas we have? Firstly we will see one concept. What is this overall concept is there? What is there? Reconciliation statement, this one not reconciliation statement. After that, firstly what are the formulas we have? What are the formulas? How the formulas will came? For which formula? How many formulas will come? You will see that. First formulas ke reasons. Yes, what is this? This was in turn. We can turn it. Turning is not there. Can I cut this? Sorry, it was not coming here. Okay, I will explain here itself. Firstly, for operating variance we have cost variances and sales margins. So we plan for one cost and we arise for another cost. So we are spending for one cost, means for example you are providing one product, we assumed 10 rupees, but it cost may go for 15 rupees or 20 rupees. That is the cost variance. We will find out the reasons. What is the reason? It may be for direct material, for the material or labor or fixed variance and variable variance. For this individually we will have separate formulas. For material variance, what is the material variance may happen? It may be due to change of price or it may be due to change of quantity. That is the case. And if it is a quantity, what quantity he is using? He is any mixed in that quantity. For example, we want to use a X product, but he used X plus 1. So that he mixed one item, so that we got the variance. That is the case. And yield variance, he has included some yield. That is the case. Next, direct labor variances. Where direct labor variances is, they are not accepting due to rate or due to efficiency variances. Here gang variances will be C, variance will be C, and fixed variance we will have separate treatment for fixed variance along. We will have same variance category for material, labor and variable, and fixed was separate category. And here sales also same. What is the sales margin? And sales margin mix variance, what you have mixed, due to that change is there, what you have mixed, we will see that one. So for this individually we have whatever here have, we price variance one formula, usage variance one formula, mix variance one formula, yield variance one formula. So we have more formulas in this chapter. For that we will see first what is there in here. We will see material variance now. So material variance, due to material change or due to labels we will change. Where it gone here? Hey. Came here. Full screen. Okay. Here where we are in. Here. See. Now, so we have material variance, labor variance, overhead variance, and fixed overhead variance and sales variance. So for that we are seeing first material variance. Material variance, what is there in material variance? For material variance we have three variances. One is traditional variance. What is the traditional variance? This is actual versus original we will see. Actual versus original we will see in traditional variance. Where planning variance means we will see the both standards only, both the budgets only, both the what the budgets are. One original budget and another one is revised budget. That is original standard and revised standard. That is planning variance. Where optional variance we will see the what is the actual and what is the revised standard. What is the actual, what is the revised standard. This is the case. Next, here we have formulas for that. We have formulas for that. So for traditional variance, what is the formula? Standard quantity. Firstly, we will seeing the material. Material means for material we have quantity and price. Maybe change in quantity or maybe change in price. So due to change in quantity or due to change in price. So if you go for quantity, so standard quantity minus actual quantity into price means standard price. Always standard price. Next, where we will see in planning variance. Planning variance. So we are seeing only quantity related differences. What is the quantity? So what is the standard quantity you are kept and what is the revised quantity into price will be standard price. Always standard price. Next, operational variance. Where operational variances we will see actual versus revised standards. So revised standard quantity minus actual quantity. What is the actual quantity? So revised into revised standard price we will take here. Revised standard price we will take here. So always actuality will be come later. Actuality will come later. First we will come standard. We will prepare standard, so that we will take first standard. That the actual will be come arise. Next, here also same. First we will prepare the actual standard and for that we come revised, so that revised will become. Next we will prepare the revised based on available information and then actual quantity. Next, direct material variance, where we will see here we will see direct material usage. So quantities. Now material price means here we will see the price is different. For price is different we will multiply with quantity. What quantity we will take? Quantity means always actual quantity. Okay. Traditional variance, which price we will take? First which price we will came? Standard price will came. So standard price minus actual price into actual quantity. Next, after that doing the operation we will revise our standard. So now which is the first price? Standard price minus revised standard price into revised standard quantity. Next, operational variance. What is the operational variance? Here revised standard price minus actual price into actual quantity. That is the case. This is material usage variance and price variance. Next, here direct material usage operational variance using standard price and direct material pricing planning various what we have discussed about, that is explaining there. Now we will see one illustration. In illustration number 1, what they provided, HDR produces units and incurs labor cost, and a change in technology after preparation of the budget resulted in 25% increase in the standard labor efficiency. Next, such that it is now possible to produce 10 units instead of 8 units. So they are firstly they assume 10 units. Now it will go for 8 units using 8 hours. So what is the 8 hours? Labor hour given. Okay. Revised standard labor hours requirement will be 0.8 hours per unit. So it is revised. So details of actual budgeted for period they are provided. Original standard, revised standard, actual quantities. So it is related to labor. Labor means always we have hours. So in material what we have seen, that is we have 3 category: traditional variance, operational variance, and planning variance. In traditional variance what we have seen, based on original and actuality we will see. Next, operational variance means revised standard and actual variance we have seen, and planning variance means actual standard and revised standard we have seen. So same like that only here also we will see that. Next, first, what is there? Traditional variance analysis. Traditional variance analysis means what? Here we will see first original and the actuality position. So 1100 units into 1, that is we first which was came standard will come standard minus actuality into price means what? Price means always standard price, so 10 rupees always standard price. Next, rate variance. Rate variance means what? We will take what is the standard price minus what is the actual price. Now we will take the quantity. Quantity means here labor, so hours. Which hours we will take? Always hours means actuality. We will take the actuality. Next, total variance we will get. Next, operational variance. Operational variance means what? Operational variance means based on revised standard and actuality. For which one will come first? So this one will come 1100 units, 11,100 units into 0.8. So revised standard minus actuality into price means what? Standard price. Which is the standard price now? 10 rupees. Next, rate variance. For rate variance which is first come 10 minus 8.5 into quantity, that is hours. Which hours we will take? Hours means actual, always actual. Next, planning variance. Planning variance means what? Efficiency variances, that is what we have. We will cut now. Actual planning variance means both standards, both plannings. For first planning we will come 1100 and 880 and into price means standard price, always standard price. Next, the rate variance means we will take rate 10 rupees rate and minus 10 rupees into how many hours? Actuality, operation, doing the operation 880. This is total variance. This is the labor case. So we will change the hours. In case of material we have quantity, in case of labor we have hours. That is the change, nothing was changed more. Here we have provided one comment, that is comment was, in this case the separation of labor cost variance into operational and planning components shows a large problem in the area of labor efficiency that might otherwise have been indicated. The operational variance are based on the revised ex post standard, and this give more meaningful performance benchmark than the original ex ante standard. So we will take the revised data. So revised data we will get from where the operations is starting. Before starting the operation we will take one standard, this much cost we will incur and this much profit we will incur. Doing starting the operation we will get the some market information, we will revise our standards. That is the revised standard. Next, direct labor efficiency variance. Here we will see labor efficiency. So in last two problem we have seen the material usage and we have discussed about material usage. Now we have seen the labor variances. Now these formulas will be for traditional variance. For labor efficiency variance means, firstly we will see the traditional variance. Traditional variance means always actual original standard, actual original standard. So standard time minus actual time into standard rate we will take. Next we will planning variance. Planning variance means both standards, so both budgets, that is which will come first to standard time minus revised time of doing the operations, minus into which rate we will take. Rate means always standard rate we will take. Next operational variance. Operational variance means actual versus revised, so which will arise first doing the operation. We will start first operations, so we will revise the standards, so revise the standard time minus what will have next actuality we will come minus actual time and revise the standard rate. Standard rate we will take. Price means always standards we will take. Quantity means always actuality we will take. Next direct labor rate variance. So rate variance means we will take the rate difference into quantity or into time in case of labor, so into time. So which time we will take? Time means actual we will take. So for traditional variance, actual versus original, so which will come first to standard we will prepare first minus actuality will come later into actual time. Next planning variance, where planning variance means firstly we will come standard rate minus revised standard rate into revised standard time. Next revised standard time minus actual rate. Firstly we will come revised standard rate and after we will come actual rate. And for quantity means always take actual time, this is the case that is related to that one. Next here they provided what does planning or operational variance. Operational variance or planning variance means what? Means a planning variance is simply revised standard to original standard. It is when planning means planned both budgets. We will see the both budgets, both standards. Next operational variance means actuality. We will write the actuality when your operational is going, then actuality will come out, operations will come out, actual results against the revised amounts. Next test your understanding. What does the controllable uncontrollable units? Controllable uncontrollable means you have started one standard and you have planning, doing the planning, and after actuality we have controllable variance are those variances which arise due to inefficiency of cost center. So we firstly we are prepare this standard and doing the operations we don't know price. For this we will prepare one budget here 10 rupees, but actual position is 12 rupees. We don't know this 12 rupees was increased due to inefficiency of cost center, or they do not have any control over this period from during the operation. At we will price as 12 rupees, but we are purchased after 1 month, its price became 15 rupees due to our the year we are not worked properly. Here controllable variance are those variance which arise due to inefficiency. Here due to inefficiency we are increasing our cost. Here we will not controllable, so we don't know the at up to the time of operation starting we don't know exactly what is the price. When started we require the quantity, but we have not purchased, we are wait for 1 month, so it is controllable, but you are not controlled. Next variance analysis in activity based costing. It is activity based costing means what it provides now. Various when you have variance analysis can be applied on activity cost, that is setup cost or product testing or quality testing, etc. Why? To gain insight into why actual cost is different from activity. So what is the different? Why actual activity is different from activity cost? Actuality is different from activity in the static budget or flexible budget. Next, interpreting cost variance for different activities requires understanding whether the cost are, it may be output unit level or batch level or product sustaining or facility sustaining cost. So we will track it. We will see the why the difference is there. why actual activity cost is different from activity cost. Activity cost, we will see that. And further, we have ABC approach is based on assumption that overheads are basically variables. So its assumption was always basically overheads are basically variables, but variables with delivery numbers and no the units outputs. Next, we will see one illustration number 2. In illustration number 2, what they provide now, N and S. NSC is a multiple product manufacturer. NSC produces the units and all over are associated with the delivery of units to its customers. Next, particulars, budget, actual. Overheads was 4000 and outputs was overheads, budget was 400, actual was 3900, output was 2000, actual output was 2100, customer is delivered 20 and 19. So here they provided so for output units 2000 outputs, but budget output was 2000, actual output was 2100, but the budget was provided only for 2000. So we required for 2100. What is the budget? We will see. For 20 deliveries is for 2000 units into we required for 2100. What will be the customer deliveries we will take? I think 20 means 0 0, we will count 0 0, we will count 2, we will count. So 210 21 2100, no, 2 zeros 2 1 ja 2 10 ja 21 deliveries, it will become 21 deliveries. So 21 deliveries 2000 now. Okay, 21 deliveries, so it will become 21 deliveries for when we will take 2100 actual. So here what we required next, what we required here is calculate efficiency variance and expenditure variance. So for we required efficiency we require. For efficiency means we are calculated this one, number of deliveries was provided. And for expenditure, what is the expenditure here? Overhead expenditure 4000 divided by 2000, it will be expenditure, budgeted expenditure was 33 2 it will become 2 1 4000 0 0 2 2 ja 2. Okay, we will see here. Now we will see the efficiency variance and expenditure variance. For this so budget overhead, so sorry overhead expenditure, how much is different in overhead expenditure? For 21 deliveries you have no 21 deliveries. Okay, for 4000 minus 3900, it will be difference was 200, correct? No. First we will see here cost impact of undertaking activities more or less than standards. So what is the standard was they provided and what is the different is there? For we will see the efficiency. What is our efficiency? Efficiency was here they provided efficiently means they provided for only 2000 units, but we require for 2100 is our efficiency. So we will calculate for 2100 how many deliveries is there. So it is 21 deliveries. We are calculated this one, 20 deliveries divided by 2000 units into 2100, that is the case, into 200 is equal to 400, that is favorable. Next, so Oh, how you got this 200? How you got this 200 means overheads. How much the overhead? That is expenditure. Expenditure divided by output units. Out with the output units. That is 4,000. 4,000 divided by 2,000. 4,000 divided by, sorry, 20, no, deliveries. What we are writing? 20 deliveries. 4,000. 4,000 divided by 20 is equal to 200. This is 200. Here we will get the 200. That is cost impact. Cost impact of undertaking activities. Undertaking of activities more or less than standards. More or less than standards. Next, expenditure variance means what is our expenditure? That is 200 rupees is expenditure for how many deliveries? For 19 deliveries, but actuality was 3,900. It was 3,900. So 19 deliveries into 200 minus 3,900 actuality. This is the case. Next, learning curve. What is this learning curve? Learning curve means simply, for example, if you are a employee, you are working for first time, you will take 100 hours for producing the one product, and if you are working for second time, you will get for 80 hours or 30 hours for producing for number of products. For you will decrease your time because you got the experience. Based on your experience, your time will be reduced. That is the learning curve impact on variance. How it will impact? Here geometric progression. Learning curve is a geometric progression which reveals that there is steadily decreasing cost for completing the given repetitive operation. So when you are doing the repetitive operation, cost will automatically decrease as the identical operations in increasingly repeated. So you are doing the same work again and again. Then if you take first time, it will take more time, but second time it will take less time, and third time it will take more or less time. That is the case. This is learning curve. Next, the amount of decrease will be less and less with each successive unit produced. So it will decrease less and less with successive unit produced. For first time units producing, successive producing, it will take much time, and second time it will take less time, and less and less it will decrease accordingly. Next, automated manufacturing is unlike to have much variation or to display regular learning curve. There may be automations may be used for this also. Next, it is here important to know that it is important to take resulting declining labor hours. Here what will decrease? Labor hours will reduction in labor hours, and cost per unit will be reduced, and in setting standard. So first time you will put for 100 hours for 200 products, but actuality for after the 50 products, that time will be decreased because of their work experience. And here cost in setting standards and labor setting standards, planning production and determining prices, setting up work schedules, it will be seen. It is be must important for here. Next, what is the provided? Here they provided one illustration. We will see the illustration. We will get some clarity about learning variance, how the learning variance impact for variances. Okay. Firstly, we will see that here City International Company is a multi-product firm and operates standard costing and budgetary controls. So it is providing both information. We'll take it. Okay. Operating standard costing and budgetary control systems. During the month of June, firm launched a new product. An extract from performance report prepared by senior accountant is as follows. So he is providing the information, output, budget information and actual information. Direct labor hours 180.74, 118.08. Actually he has taken less time. And he produced less quantity also, where direct labor cost was decreased 1,19,288 and 79,708. Okay, for this we required for learning curve. So here what he is providing, senior account is prepared performance report for new product and certain assumptions, but later on he realized that this new product has similarity with other existing products of the company. Accordingly, rate of learning should be 80%. What is meant by this 80%? This means 80% learning curve effect means for the first time you will take, for example, if you take 100 hours, for second time 100 into 80% you will take 80 hours, for third time 80 into 80%, so third time you will take 64 hours, next 64 into 80%, 51.2%, so fourth time you will take the 51.2 hours. That is the 80% learning curve effect. Next, for this that the learning would be seized after 15 units. So up to this is for first unit, after 15 units, second unit, third unit, fourth unit, up to we will calculate for 15th unit. For 15th unit, after 15 units learning curve will be stopped, so it will take same time. So for example, if you got here 10 hours, then we will continue for our another products 10 hours only, so we will require minimum time, we will reach the minimum time. Next, the original budget figures are based on the assumptions that labor has learning rate of 90% and learning will be seized learning. Okay, it is providing original budget. Now original budget figures are based on the assumption that labor has learning rate of 90%. So for the budget he has taken 90% learning curve. Okay, next, learning curve will cease after 20 units. For year he provided 15 units, now it will providing cease of after 20 units. So what is this? Here we will see up to 20 units we will have learning curve of 80% will decrease. For here the standard time for remaining products. Next, the same time at the final units during the learning period. Next, the how much units we have, we are budgetly 30 units and actually 25 units. For up to 20 we have the learning curve effect. After that we will reach the minimum time and we will produce that same minimum time. Next, so what they provide, show the variance that reconcile the actual labor figures with the revised budget figures for actual output as much as detail as possible. Next, the learning index values of for 90% and 80% learning curve will be 0.182, 0.152 minus or 0.322, and here we will calculate. For example, here they provided, if we see for that, for actuality position after 15, here up to 15 we will have, after 15 we don't know. Up to 15 means we will have the information of 80% decreasing, and here we don't know. So for this we want to calculate, we will take assume 16th unit will be y, or in the case of 21 units we will take that y. We will calculate the y formula will be y is equal to a x to the power of b, a x to the power of d. What is the a? A means time required for first unit. What is the time required for first unit? We will take how much time we will require. For first unit we will require 10 hours. They provided here. For first unit is required 10 hours into x. X means cumulative number of units produced. How many units was provided? So after 15 it was, so up to we have produced already 14. So for 14 we have produced, we will take here a means 10 hours into x means after 15 means up to we have produced already 14 we have produced. First to 14 was produced. After 15 means we have produced up to, we will take 15 minus what was provided, minus 0.322. we will calculate here clearly. For here we will take here, so y is equal to how much time you require, 10 into after 15 it will cease means, so they are provided 15, and for 80% learning curve efficient means minus 0.322. We are taking this, why? Because we are calculating 80% curve, and we want for up to 14th also, for 14th means what we will take, 10 into 14 to the power of minus 0.322. So we will calculate both 14th, from 15th to we have one curve, 15 to 1 we have total time, and up to 14 we have one time. Next, after that we have for how many required for actuality, 25 units, for 25 units. So from 15 to 25 we have one time, that is for whatever answer we will get for 15, here 15, this will be for remaining 25 units, time taken for 25 units. For first unit it will get, here we will get, for next unit we will get here, that is the case, and we will for 15th unit, this will be the difference, 15th unit this will be the difference of that one. Next, for 15 units we will get the 15 units we will get, and for 15 units, and we will calculate for 14 units, and the difference will be the next 10 units. This is the case of first one. This is the case of for 80% curve. Now we will see the formulas and what are the provided answer. Answer will be so y is equal to, so time required for first 15 units based on the revised curve 80%, when the time required for first unit is 10 hours. Y is equal to 10 into 15 minus 0.322, that is 80% curve efficiency we will take. Now we will apply log on both side. For log on both side, when we applied both side we will take the log, and here they provided the log values. So for log values, log 2 was provided, log 3 was provided, log 5 was provided, log 7 was provided, but we don't have log 15 value. So we will see the from based information, do you have any relationship with provided information? Log 2 there is no relationship with log 2 and log 5, and log 3 we do not have, we have relationship with log 3 and log 15, but we require log 5 also. Log 3 and log 5 is there, so 3 into 5 it will become 15. So what we will see now, we will bifurcate it. When in logs we have, if you have a log AB, then we will write it as a log A plus log B. This is, if you have a log A to the power of B, then it will be write as B log A. This is the case in case of log A logs. So log 5 into 3 means log AB. So we can write it as a log 5 plus log 3 into coefficient value. Coefficient value will come down. Why? This is the case of log A to the power of B, that is log A to the power of 0.32. B will be come down, so 0.322 will come down. Now we will for log 10 values, log 10 will be 1, log 100 will be 2, log 1000 will be 3. This is the case. So we have log 10 means it will be one value, so we will get the log y, and if you transfer this log into this side, we will get the anti-lag, where anti-lag value they provided anti-lag value 0.32. here they provided, see here anti-lag 0.6213 was 4.18. so we will take it value they provided, here we will take it, and for we will take 4.181, and this is 62.72. this is for first 15 units. Now we will require for 14 units. 14 units, and for 14 units we will calculate 14 units. For 14 units how we will get same what we have calculated above, same we will take y is equal to a into b to the power a into x to the power of b. So 10 for how many hours we will take for first unit, 10 hours into 14 units, 14 units based on the revised learning curve, that is 80%. This is 80%. Budgeted was 90%, but we will not go with budgets, we will go for actuality. So same calculation and 14, and what is the relation is there, 2 into 7, and we have 2 value and log 2 7 value, and that 0.332 will come down based on this one. Next we will calculate the this and anti-log value provided. For log 14 units we will calculate the amounts. So 14th anti-log value 4.275, and we will got the amounts. So for first 15 units it will be 62.72 hours, and for next 10 units this will be 62.72, that is related to 15 units, that is 15 units, and minus 14 units 59.85. This is we will get the one unit, but we require for 10 units. 1 unit into 10 units we will get the 28.75. So we will add for that 15 units plus 10 units value, we will get the total 25 units, total time for 25 units. This is the case. And computation of standard and actual rate. What is this standard and actual rate? Standard rate is equal to here for labor cost we provided that. So for here we will see in question only. Here they provided that. So here how much the direct labor cost was provided? Direct labor cost was 119,288 divided by how many hours he has taken, 180.74, and we will here we will see actual rate 79,704 divided by 118.08, and we will get the hours. Here we will get 675 for this one, 675, and this one we will get the 660 hours. We will get the hours. So we will calculate the variance. What is the variance is there? See here we will get this. We will divided it, and for that we will get the 660. Where we will get 660? Here we will get the 660. We will get the standard rate and actual rate. And for quantity, actual hours will be taken. Actual hours will be 118.08. 118.08, that is the actual hours. Next, labor efficiency. So labor, this is rate efficiency. For rate we have taken rate difference and actual hours. For labor efficiency variance means we will take hours for different hours, and rate will be R rate, standard rate, always standard rate. Hours means or quantity means actual we will take. For labor efficiency variance means it will take efficiency variance, that is hours, how many hours they are worked for efficiently. So we will difference, we will see our efficiency hours, and we will take the rate, standard rate. Next, statement of reconciliation, that is actual figures versus budgeted figures. What is their actual was provided 79,704. Now what is the variances we come? So both are adverse only. So adverse means unfavorable means we need to deduct 79,704 minus 1,771 minus 17,595 minus we will get the budgeted cost, revised budgeted cost. Now for revised budgeted cost, budgeted labor cost will be standard hours into standard rate. What is the standard hours we have? Standard hours we have calculated. We have standard hours 19,091.42 into what is the standard rate? 660 will be the standard rate. So budgeted labor cost will be revised will be 60,3 377.2 60,337.2 we have calculated in a statement of reconciliation, and we are calculated directly also. This is the case of which one we have calculated for when we have a lightning curve efficiency, how we'll get the variance, this is the case. And remaining we will see how much, so remaining we will see in next class.